Hey everyone, welcome back to the channel. In this video, I'm walking through 10 essential personal finance lessons that changed my life. And I believe they can change yours too, if you actually put them into practice. So let's skip the fluff and dive right into personal finance lesson number 1. Delayed gratification is foundational. If you can resist grabbing the immediate reward, the payoff down the line is usually much bigger. You see this all the time with investing. Let's say you put money into the stock market and simply buy and hold for a long stretch. 10, 30, even 50 years. The longer you hold, the larger your gains tend to become. It's the same reason countless financial professionals tell you to leave your savings and 401k alone. They know that the more time your money has to compound inside those accounts, the better your retirement outlook typically gets. For everyday buying decisions, I like to compress delayed gratification into one rule of thumb. If you can't afford to buy it twice, don't buy it. The logic is pretty straightforward. If you could comfortably purchase an item 2 times over, you're likely in a solid enough position to buy it once without straining your budget. For example, imagine you want something priced at $500, maybe a new Xbox or PS5, and technically, you can cover it. But the idea of a purchase in the 5-figure range, say $11,000 or more, feels intimidating. That's a sign the $500 spend might be premature. If the thought of that larger hypothetical price point makes you uneasy, it's probably wise to hold off on the smaller purchase for now. Delayed gratification also sharpens big choices. When you're staring down a major decision, like a career shift, zooming out 10 or 20 years usually brings clarity. I remember being in that exact spot at work. I was in the monetization team at a mobile gaming company and considered switching to marketing because the base salary was higher. Short-term me was tempted by the extra $10,000 to $20,000 for roughly the same hours. But when I asked myself what I wanted to be doing a decade or two from now, the honest answer wasn't marketing. In the long view, the quick raise didn't make sense. When you fuse long-term thinking with delayed gratification, you become incredibly difficult to throw off course. Personal finance lesson number 2 is to track 3 numbers I call the big 3: your expenses, your savings rate, and your net worth. If you measure these consistently and make incremental improvements, your financial life almost inevitably trends upward. Start with expenses. Track your fixed costs: transportation, housing, utilities, healthcare, insurance, and so on. And make sure they don't eat more than roughly 50 to 60% of your income. If fixed costs swell past 60%, the rest of your budget gets squeezed, and you may not have enough left for discretionary spending or meaningful saving and investing. For discretionary spending, I keep myself in check by tracking every purchase and building in frequent mid-month reviews. For instance, if your monthly target for discretionary expenses is $1,500, then a halfway checkpoint on the 15th should have you near $750. If you're already sitting at $800 or $900 by mid-month, that's your cue to throttle back for the remainder. Small, timely corrections beat end-of-month panic cuts every time. When it comes to your personal savings rate, aim to start around 10% of your income and nudge it higher as you can. Keeping your savings rate visible keeps you mindful of it, and the goal is to see that percentage creep up over time. As your savings rate rises, you automatically free more dollars for things like investing, which is where long-term growth happens. Look at all this floor space. So much room for activities. So many activities. Step class, aerobics. The head spins at how many financial activities open up when you create margin. Now about net worth. This is the 3rd number I track, largely for perspective and peace of mind. It's an excellent way to zoom out and see the trajectory of your financial life. I'll sometimes scroll back through my expense tracker, say from 2020 or 2021, and compare how my net worth has moved over time. If you'd like my template, I built a net worth tracker a couple of years ago and made it completely free. I'll drop a link to it in the description. Personal finance lesson number 3 that genuinely transformed how I invest. You don't need to own a ton of different things. I see this all the time in friends and subscribers' portfolios. People stack way too many ETFs and too many individual stocks, believing more tickers equals more diversification. Often, it just creates overlap and confusion. Plenty of investors think they're doing the right thing by holding 10 or 12 ETFs, but a quick look under the hood shows lots of redundancy. For example, take ticker symbol VO, Vanguard's S&P 500 ETF, and pair it with VOE, Vanguard's Mid-Cap Value ETF. You'll find that 92.1% of VOE's holdings are already inside VO. So while it feels like you're diversifying, you may be doing the opposite, piling on exposure to similar names and potentially making things worse. Most broad index tracking ETFs are already simple and highly diversified. In many cases, you just need 1, 2, or at most 3 core funds. If you're holding far more than that, you might be complicating your life without gaining real protection. Investing should be simple and largely passive. And here's a grounding reality check. Most casual investors who stuck with a low-cost S&P 500 ETF over the last 15 years would have outperformed 92% of large active fund managers, according to S&P Global. Simplicity wins far more often than our instincts want to admit. All right, personal finance lesson number 4 today is to be mindful of big purchases that are depreciating assets. We all know cars lose value, but plenty of other things do too. Jewelry and watches, clothing, books, smartphones, even computers. If you're spending on assets that decline in value, the worst move is borrowing to buy them. At that point, you're paying a lender high interest to finance something that's dropping in price. You're literally paying money to lose money. I'm usually talking about items like jewelry, clothing, or furniture. Think about the last time you bought a new couch for $2,000. 3 years later, you list it on Facebook Marketplace and it goes for $200. You just ate an $1,800 loss. Plus, there's the hassle that the buyer might not even show up. If you've dealt with Facebook Marketplace, you know the drill. They say they're on the way, and then they ghost. It's an emotional roller coaster. Okay, enough marketplace drama. Let's move on to personal finance lesson number 5. Lesson number 5. If you invest for more than 20 years, your results should typically be positive. In the well-known post on the Dollars and Data blog, there's a compelling case for why retail investors should stay invested for the long run. He highlights that as stocks get more expensive, using the PE ratio as a proxy, future returns tend to be lower. That logic tracks. If you buy something overvalued, you shouldn't expect the same upside as when you buy it undervalued. You can see that as P/E ratios climb, there's a negative relationship with the next 5 years of returns. There are simply more red dots, negative 5-year outcomes, in the 30 to 40 PE range than in the 10 to 20 range. What's fascinating is how the picture changes as your holding period extends. As you look out 5, 10, 15, 20, 25 years and beyond, the red dots steadily thin out. The author notes that over any 20-year period, U.S. stocks have had no real negative returns when including dividends. And over 30 years, returns tend to converge even with some dispersion. The takeaway is straightforward. If your goal is to build wealth, keep buying into the market as long as your time horizon is 20 years or more. The odds of losing money shrink dramatically with time. A lot of people declare the market overvalued and stop investing altogether. The post uses a great example. Search stock market overvalued 2012, and you'll find plenty of pieces arguing prices were 50% too high back then. But the S&P 500 was around the 1,400s in 2012. And anyone who sat out because of those calls missed a decade of substantial gains. Personal finance lesson number 6 is that saving money is incredibly important, especially at the beginning. People often assume growing wealth is all about stellar investment performance or a breakout business. But when you're starting from a small base, the real needle mover is aggressive saving. Your first priority is to build an initial nest egg so it can compound later. And then your money starts earning money on its own. That's why the first $100,000 usually comes more from savings than investment returns. Look at the calculator from the 4-Pillar Freedom blog. If you save $13,300 a year for 6 years and earn a 7.5% return, you'll end up with about $101,000 after 6 years. Of that total, roughly 77% is from your savings, not growth. Another scenario: save $10,000 a year at a 10% return. It takes 7 years to cross roughly $104,000, and your savings still make up about 67% of the total. With compounding, the heaviest friction is upfront. That's why dollars saved early, when your account is small, are disproportionately powerful later. Those early contributions get the most time to work. There's no magic trick to getting over that initial hump. Building your starter nest egg takes discipline, consistent saving, and patience. If you're new to this, stick with it. Every dollar you stash now buys you future freedom, as compounding does its job. Personal finance lesson number 7 that changed my life is this: investing should be boring. You probably won't build real wealth by day trading, but you can grow rich over time by buying something broad, like an index fund, then leaving it alone. I want to share a clip from my podcast with Morgan Housel, author of The Psychology of Money, because it nails the point. Your book taught me that successful investing is when you lose the password to your investment account. Yes, that's exactly it. I don't think I literally wrote that line, but the idea fits. When I realize I don't remember my login, I'm proud of myself. It means I haven't checked in ages. That's the spirit we should aim for. Forget your account password, provided your overall portfolio is well diversified. If your time horizon is 10, 20, 30 years or more, the best move is to hold and keep dollar cost averaging. Just continue contributing and investing. I know this approach seems dull and average, but listen to this follow-up from the same episode on why you shouldn't try to beat the market and should instead target average returns. I think it's extremely hard to beat the market, and very few people will do it. There are people I believe can, and even people I'd trust with my money. The reason I don't is not because it's impossible. It's because the metric I care about most is endurance. If I can earn average returns for an above average amount of time, that alone will put me in the top 5% of investors. There it is. Top 5% simply by being average and by doing the boring stuff, like owning index funds and stepping aside. Personal finance lesson number 8 is to stop paying attention to your peers for comparison. Not that you should ignore people entirely, but don't measure yourself against them. Personal finance is a lifelong journey, and it's tempting to stack yourself up against friends, coworkers, or people your age. With social media, it's in your face nonstop, but everyone is on a different path, with different starting points, obligations, and goals. And those glossy posts online? They're highlight reels. You don't see the backstage. No one is going to walk up and flash their banking app saying, "Here's my balance, feel bad." That's not real life. Comparing wastes time and mental energy you could use to improve your own situation. Some people spend everything. Some people save relentlessly. Many sit in the middle. People value different things too, so their spending will reflect that. Easier said than done, but I've noticed that when I stop comparing, my impulse to make random purchases drops as well. Personal finance lesson number 9 is closely related. Avoid becoming the $30,000 millionaire. I learned this phrase in Texas. According to Urban Dictionary, these are people earning around $30,000 a year who act like they're multi-millionaires. Picture the $30,000 millionaire rolling up in a leased BMW while still living with their parents. Or the person who books the VIP table at the club and then can't afford the drinks because the table ate the entire budget. That's $30,000 millionaire energy. The point is simple. The folks who look wealthy often aren't. And the people who truly have money usually don't dress or behave like it. Research on millionaires consistently shows most live well below their means. That's how they got there. My favorite line from The Millionaire Next Door is, "If your goal is to become financially secure, you'll probably achieve it. But if your motive is to make money to spend money on the good life, you'll never make it." It's a reminder that focusing on your own goals and staying within your means is what leads to financial freedom and security. Don't be the $30,000 millionaire. Personal finance lesson number 10 that changed my life is that what's risky for you might be safe for someone else, and the reverse. Just like you shouldn't compare yourself to other people, You also shouldn't mirror their choices just because they made them. Your risk profile will be different from your neighbors. When you take in financial information or advice from anyone, run it through your own filter and ask whether it fits your situation. General guidance isn't one size fits all. Even on this channel or on any other channel, you should apply the same lens. Does this decision make sense for me? It's fine to gather ideas, inspiration, and starting points from the internet, TV, friends, or anywhere else. Just be intentional about what you actually implement in your own life. All right, those were my top 10 personal finance lessons. Tell me what you think in the comments. Hit the subscribe button below. It takes a split second, and I'll see you in the next video. Or in that one. All right, peace.